All right, welcome in everyone. We're diving into a pretty important topic today. Net operating income, or NOI for short. It's kind of the heart and soul of commercial real estate finance. We'll be using Cara Conde's guide, The Ultimate Guide to NOI in Commercial Real Estate. It's really fantastic stuff. What we want to do is sort of, cut through the noise and figure out why NOI is so crucial, especially right here in Indianapolis as of, well, right now, March 2025.
It's really about getting to the core of what drives value. No need to get bogged down in all the technicalities.
Exactly. And, Cara Conde, I mean, she's a true expert in Indianapolis real estate, right? She even calls NOI the heartbeat of financial analysis in commercial real estate. So I think we can all agree it's pretty foundational.
Absolutely. And having Kara's perspective, particularly her experience in the Indianapolis market, is going to be so helpful for understanding how this all plays out in the real world.
Okay, so first things first, let's break it down. What exactly is net operating income? Like, how would you explain it to someone who's maybe just starting to dip their toes into commercial real estate?
So, in the simplest terms, NOI is all about the income a commercial property generates, minus those necessary operating expenses, like the everyday costs of just running the property, keeping it up and functional. But here's a key point. We're not talking about mortgage payments, income taxes, or those big one-time capital expenditures. Like if you had to replace the entire roof, that wouldn't be factored into NOI.
Got it. So it's like the pure income generated just from the property's normal operations.
Exactly. And that income, well, it can come from a few different places. Like if we think about retail space, there's base rent, but often you'll find percentage rent as well. This basically means the landlord gets a cut of the tenant's sales if they exceed a certain amount. It's a way for the landlord to share in the success of the business.
That makes sense. So a win-win situation in a way.
Right. And then you might have parking fees, vending machines, maybe even laundry facilities if it's a mixed-use building.
Yeah.
Those little extras can add up over time.
Oh, for sure. Every bit counts. Now, on the expense side, what are some typical things that would get subtracted?
Well, we've got those property management fees, the costs of utilities, routine maintenance, just keeping everything in good shape. Then there's insurance premiums and the cost of janitorial services to keep things nice and clean.
Essentially, all the essential costs of keeping the property running smoothly day in and day out. Now, I know Cara Conde really emphasizes that NOI is the gold standard in commercial real estate, especially when you compare it to, say, residential real estate, where people might focus more on cash flow. Why is that? What makes NOI so special?
It comes down to standardization. NOI gives us a very clear, consistent way to evaluate how well a commercial property is being managed and operated. Whereas in residential real estate, an owner's individual financing choices can really skew the cash flow picture. But with NOI, those financing costs are stripped away, so you're comparing apples to apples based purely on operational efficiency.
So it levels the playing field?
Precisely. It's all about the underlying business of the property itself. And Kara puts it beautifully. She says, in commercial real estate, NOI isn't just a number, it's a story. It tells you how well a property is performing and where there's room to grow.
I love that. It really is a narrative, a measure of health and potential. Okay, so we know what NOI is, but why is it so crucial in the world of commercial real estate? What does understanding NOI actually unlock for us?
Well, for starters, NOI is the cornerstone of how we value commercial property. It's the basis for calculating the capitalization rate, better known as the cap rate.
Ah, yes, the cap rate. It's a term we hear thrown around constantly, but it can be a bit mysterious. How does NOI fit into the equation?
It's a straightforward formula. You take the property's net operating income and divide it by its current market value. For instance, let's say a property is generating an NOI of $500,000 and it's listed at $10 million. The cap rate would be 5%.
Okay, so that percentage, the cap rate, is essentially telling you the potential return on your investment, right? So generally, a higher cap rate would indicate a potentially better return.
Generally speaking, yes. A higher cap rate often reflects higher perceived risk or potentially greater growth potential in the market. But we have to be careful. It's not always a simple equation.
Right. Every market has its own quirks, and different types of properties will behave differently.
For sure. Like a rising cap rate in Indianapolis might signal increasing risk or maybe a softening in demand. It's all about reading those market signals.
So context is everything. Now, apart from valuation, what else makes NOI so important?
Well, lenders absolutely depend on NOI when they're deciding whether or not to finance a commercial property. They use it to calculate the debt service coverage ratio, or DSCR. This basically compares the property's NOI to its annual debt payments. They're looking to see if the property can comfortably handle its mortgage obligations.
So a strong NOI is essentially a signal to lenders that the property is a safe bet.
It gives them that assurance, that financial cushion they're looking for. And then NOI also acts as a performance gauge for property managers. By closely tracking NOI, owners can see where they might be able to cut costs or find ways to increase revenue. It helps identify inefficiencies and highlights areas for improvement.
So it's like a report card for the property manager?
You got it. And naturally, any significant shifts in NOI will directly impact the property's overall value and the returns an investor can expect. Improve the NOI, and you'll likely improve the property's market value.
And Cara Conde's experience in Indianapolis really underscores this, right? She talks about identifying properties that might seem undervalued at first glance, but then finding ways to optimize their NOI and unlock that hidden value.
Exactly. She's a master at spotting those opportunities.
Yeah.
Maybe it's through better tenant management or perhaps implementing cost-saving measures. She's all about uncovering those hidden gems.
So NOI is really the engine driving everything. Now let's get practical. How do you actually calculate NOI for a commercial property? What are the steps involved?
All right, so the calculation follows a pretty logical process. We begin with something called the gross potential income, or GPI. This is the maximum potential income the property could generate if every single unit was leased out at full market rent, like a perfect world scenario.
Give us a real-world example here in Indianapolis.
Sure. Imagine a 10-unit apartment building here in Indy. Let's say each unit could realistically rent for around $1,500 a month. That's $18,000 per unit annually, which gives you a total GPI for the entire building of $180,000.
Got it. That's the best case scenario. Full occupancy, no vacancies.
Right. But of course, the real world isn't always perfect. So the next step is to calculate what's called the effective gross income, or EGI. This is your GPI, but we factor in vacancy and credit losses. You know, those times when units are empty or maybe a tenant doesn't pay their rent.
We got to be realistic.
Exactly. So let's say that in this apartment building, on average, one unit is vacant at any given time, and there are, let's say, $2,000 a year in unpaid rent. That gives you a total of $20,000 in vacancy and credit losses. To get your EGI, you subtract that $20,000 from the $180,000 GPI, leaving you with $160,000.
Okay, so now we have the more realistic income figure. What comes next?
Next, we factor in those day-to-day operating expenses. Let's say your annual property management fees for this building are $8,000, utilities are $12,000, insurance costs you $6,000, and routine maintenance runs about $10,000. That totals up to $36,000 in operating expenses.
And just to reiterate, the mortgage payment and any big capital improvements like a complete roof replacement, those aren't included here, right?
Exactly. NOI focuses solely on the recurring costs of normal operations. Now, to arrive at the NOI, we simply subtract those total operating expenses from the effective gross income. In our example, it's $160,000 minus $36,000, leaving you with an NOI of $124,000 for the year.
It all makes sense when you lay it out step by step. Now, I know Cara Conde cautions against some common mistakes people make when calculating NOI. What are some of those pitfalls?
Oh, there are a few common ones. The biggest one is probably mistakenly including mortgage interest payments as an operating expense, which it's not. Another one is overlooking those less obvious recurring operational costs. Things like seasonal landscaping, maybe pest control services, or even professional fees. Cara really stresses the importance of being thorough, double-checking all those expenses to get the most accurate NOI.
So it's all about getting into the nitty-gritty, not just looking at the big picture. All right, let's zoom in on our local market here. How does NOI specifically play out in the Indianapolis commercial real estate scene as of March 2025?
Well, the Indianapolis market right now is pretty vibrant. We've got a great mix of office spaces, retail locations, industrial properties. There's a lot going on. But the NOI you might encounter, it can vary quite a bit depending on where exactly in the city a property is and what type of property it is. For example, a prime office building downtown with high occupancy and lots of tenant demand, that's probably going to generate a much higher NOI compared to a similar building, say, in a more up-and-coming neighborhood.
So location, 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 it affects not just the rent you can charge, but also your expenses and the likelihood of vacancies.
It's all connected. Plus, we've got those unique local factors here in Indianapolis that come into play. Think property tax rates, the cost of utilities, and the general trends in tenant retention for different property types. They all influence the NOI you can expect.
Can you give us an example of how different property types and locations might affect NOI here in Indy?
Absolutely. So let's imagine a large warehouse out in one of our industrial parks. It might have lower ongoing maintenance costs compared to, say, a retail storefront on a busy street. But that warehouse might also carry a higher risk of vacancy.
I see. Depends on what kind of businesses are looking for space at that particular moment.
Right. Then you've got the flip side, a retail property in a hot spot like Mass Ave. They can demand higher rents, probably generate a higher NOI, but they might also face steeper property taxes or tougher competition, which could impact tenant retention.
It's a balancing act for sure. And I remember Cara Conde has a great real-world example of boosting NOI for a downtown office building, right?
Yes. She worked with a client who owned a building downtown and managed to increase the NOI by a whopping 15%. And they didn't do any huge renovations or anything. It was all about strategically renegotiating those leases with the existing tenants and making some key energy-efficient upgrades, which directly reduced those ongoing operating costs. It really highlights how a deep understanding of NOI, combined with that local market savvy, can make a huge difference.
That's such a practical example. Okay, let's move on to some of the more advanced NOI concepts. What are some of the things that people should understand beyond the basic calculation?
So one important concept is stabilized NOI. This basically represents the projected NOI of a property when it's operating at, a steady high occupancy rate with those typical normalized operating expenses. It's a way to visualize the long-term earning potential once the property has settled into a stable rhythm. It helps smooth out any initial fluctuations you might see with a newer property.
So it's less about the short-term ups and downs and more about that long-term consistent performance.
Exactly. Then we have projected NOI, which comes into play when you're thinking about making improvements to a property. It forecasts what the NOI is expected to be after those renovations or upgrades are done. It's all about projecting the impact of those value-add changes.
So essentially, it's a tool to assess the potential return on those investments. And what about the NOI margin?
The NOI margin is a great way to measure operational efficiency. It tells you how much of your revenue is actually making its way into profit after covering those operating expenses. You calculate it by dividing the NOI by the total revenue. So for example, a 70% NOI margin means that for every dollar of revenue, 70 cents is left over as NOI after paying those expenses.
Ah, that's a clear way to compare how well different properties are performing operationally.
Right. And then we have to talk about lease structures because they have a big impact on NOI, both in terms of how much you can expect and how predictable it will be.
I imagine different lease types can really shift the dynamics.
Absolutely. So with a triple net lease, or NNN, the tenants are responsible for most of the property's expenses. Think property taxes, insurance, a lot of maintenance costs. This creates a more stable NOI for the landlord because those variable costs are passed through to the tenants. But with gross leases, the landlord typically covers more of those expenses.
So a triple net lease can be more hands-off for the landlord, but maybe a bit less predictable in terms of revenue.
It depends on the situation, but yes, that's a good way to think about it.
Hmm.
And lastly, we need to remember that seasonal trends can also affect NOI, especially in areas like retail. You might see a big spike in income during the holiday season, for instance. So CARE really emphasizes the importance of looking at NOI trends over time, not just a snapshot at one moment.
Makes sense. Got to see the bigger picture. Okay, let's shift gears to something every property owner wants to know. How to maximize that NOI. What are some proven strategies to boost that bottom line?
Well, the two main avenues are increasing revenue and reducing expenses. On the revenue side, one of the most straightforward approaches is to make sure your rents are aligned with the current market rates. You can also explore adding new sources of income, maybe leasing out some unused space.
Get creative with those spaces.
Right, and of course, minimizing those vacancy rates is crucial. Every empty unit is lost income.
So keep those units filled. What about on the expense side? How can property owners cut down on costs?
A lot of owners are finding that energy-efficient upgrades can make a big difference. Things like switching to LED lighting or upgrading to a more efficient HVAC system can significantly lower those utility bills.
Makes sense. Those energy savings can really add up.
Another good strategy is negotiating bulk contracts with vendors for services like trash removal or landscaping. And you might be surprised to hear that investing in preventive maintenance can actually save you money down the line. It's all about catching those small issues before they become big, expensive problems.
A stitch in time saves nine, as they say. Now, Cara Conde also talks about value-add plays. What are those?
Value-add plays are strategic investments in a property with the goal of increasing its value and its NOI potential. Think Renovations, upgrades, even repositioning the entire property. For example, maybe converting an outdated office building into a trendy mixed-use space with apartments and shops.
But so it's about being proactive and finding ways to enhance the property.
Exactly. And Cara shares this great story about a warehouse owner who increased their NOI by 20%. They added a new loading dock, which attracted a higher-paying tenant. And then they also upgraded the insulation, which lowered their energy costs. They tackled both revenue and expenses.
Smart moves. Okay, let's move on to our People Also Ask segment where we answer some common questions about NOI. First one, what's the difference between NOI and just plain old net income?
This trips people up all the time. So remember, NOI is the property's operating profit before factoring in debt payments and income taxes. It's the money made just from operations. Net income, on the other hand, is the bottom line profit after you've paid all those expenses, including your mortgage, taxes, and even depreciation.
So NOI is a measure of operational efficiency, while net income is your actual take-home profit. Got it. Next question. How are NOI, cap rate, and property value all related?
They're interconnected pieces of the puzzle. Remember, cap rate is calculated by dividing NOI by property value. But you can also use that equation to figure out the value of a property if you know the NOI and the prevailing cap rate in the market. They're all dependent on each other.
It's all about the relationship between those three key elements. Why is understanding NOI so important for commercial real estate investors?
It's all about assessing the financial potential. Investors use NOI to compare different properties, evaluate their profitability, and ultimately decide which ones are the best fit for their investment goals. A healthy NOI generally signals a more attractive opportunity.
Makes perfect sense. Now, can a property have a negative NOI? And if so, what does that mean?
Yes, unfortunately, it can happen. A negative NOI means the property is costing more to operate than it's bringing in. This is a major red flag, and owners need to take action quickly. Cutting unnecessary expenses, attracting higher-paying tenants, those are some immediate steps.
Definitely a situation to avoid. What about property taxes? Where do they fit into the NOI calculation?
Typically, property taxes are considered an operating expense, so they're subtracted from your effective gross income to arrive at the NOI. But Cara does mention that local regulations can sometimes have specific nuances.
So it's always good to check with a local expert just to be sure.
Absolutely. Now, we've talked about NOI being pre-financing, so what's the difference between NOI and the cash flow an investor actually receives? Cash flow is what's left after you've paid all your debt service, your mortgage, and taken care of any capital expenditures. So NOI shows the operational profitability, while cash flow is the real spendable money in your pocket after all the bills are paid.
So NOI is the potential and cash flow is the reality. How does Cara Conde use NOI to help her clients here in Indianapolis?
Cara uses her NOI expertise in all sorts of ways. She analyzes NOI to identify promising investment properties, advises owners on how to maximize their NOI, and even uses projections to help structure deals that align with her clients' goals and risk tolerance. It's a core tool in her arsenal.
So she's basically using NOI as a roadmap for success in the Indianapolis market. And one last question. How often should you be recalculating NOI?
Cara suggests at least quarterly for properties with fluctuating income or expenses. For more stable properties, an annual recalculation might be enough. But the key is to revisit those calculations anytime there are major changes in occupancy, rental rates, or operating costs. Stay vigilant.
All right, let's wrap up with a final important section, common NOI pitfalls and how to avoid them. What are some frequent mistakes people make, and what are Cara Conde's tips for staying on the right track?
One of the most common mistakes is accidentally including those capital expenditures, like a new roof, as an operating expense when calculating NOI. Remember, NOI is all about those routine operational costs. Another pitfall is being overly optimistic about rental income and not factoring in realistic vacancy rates or potential losses from unpaid rent.
So temper that enthusiasm with a dose of realism.
Exactly. And don't forget to keep an eye on those market changes. New competition can impact your rental rates and affect your NOI, so stay informed. Cara's advice is to regularly audit your income and expenses and stress test your projections against different scenarios. It's better to be prepared for those bumps in the road.
Great advice. Well, we've certainly covered a lot of ground today exploring the world of net operating income.
It's been a deep dive, for sure, and it's clear that NOI is much more than just a number. It's the lifeblood of commercial real estate, crucial for valuation, investment strategy, even getting financing.
And as we've learned, having a strong understanding of NOI, especially in a dynamic market like Indianapolis in 2025, can be a game changer. And if you're looking for a trusted guide in this landscape, Cara Conde, with her deep knowledge and experience, seems like the perfect partner.
Absolutely. Her insights into the Indianapolis market and her knack for using NOI to unlock value make her an invaluable resource for anyone involved in commercial real estate.
So here's something to think about as we wrap up. The next time you come across a commercial property, whether you're just passing by or considering an investment, try to look beyond the surface. Think about the potential net operating income. How much could it realistically generate? What are the likely operating expenses? How well is it being managed? This NOI-focused perspective can really change how you perceive the value of any property you encounter. Thanks for joining us on this deep dive.